Okay, excellent. The main topic we'll discuss in this lesson are the different ways which companies raise equity. First of all, there are two main types of firms based on the type of shareholders they have. The first category are private companies, because they are owned by a few people and their shares are not traded in a public market. The other type of companies are public companies. The shares of these firms are traded to the public on different stock exchanges, such as the New York and London stock exchanges. Usually, the first investors in a private company are its founders. Quite often, they do that with their own savings and manage to grow the company bigger in time. This is the so-called bootstrapping process. In addition, in an early stage of development, some companies receive financing from venture capital funds and business angels. Venture capital funds are investment vehicles collecting money from institutional investors, providing seed and second-stage financing to a number of small, newly started businesses. The idea is that at least a few of these companies will become successful and will thus more than compensate for the great number of ventures that will fail. Business angels are wealthy private individuals who have a very similar mindset like the one of venture capital funds. Sometimes business angels can also provide mentorship, given that in most likelihood they have walked the same path a few years ago. Of course, companies are able to increase their equity if they are profitable too. However, sometimes it isn't optimal to wait and refinance a business with its own profits, especially in early stages, when startups need to grow fast, or their competitors will catch up and will push them out of the business. And at such early times, it is quite hard to secure debt financing, because new businesses have very limited collateral in most cases. The only viable option is a new equity investment. However, it would be understandable if existing shareholders are reluctant to risk even more and increase their investment, right? In most cases, startup businesses will have to find additional financing elsewhere. At this stage, the startup firms with strong growth opportunities will likely attract private equity funds. These funds are typically larger than venture capital vehicles and are also financed by professional investors. Due to their size and funding, private equity investors are able to invest a greater amount of money in a company and are typically interested in a larger ownership stake. Their goal is to enter and exit an investment in a 5 years time frame. Going public is a critical moment in the life of any company. This means that it has grown from a small business to a large entity, which is ready to get public investors on board. The company's shares will be sold to public investors, and they will be able to determine who will run the business and who will sit on the board of directors. As you can imagine, this is a very complex process that needs to be carried out at the right time. The founders of the company want to sell at the right price and monetize their hard work. The same is valid for the other investors who have backed the business since its inception and at later stages of development. At the same time, public investors are interested in making an investment in a company that has great management and a great growth potential. The company that is going public will have to increase its administrative and finance staff significantly. It will have to prepare a number of documents and financial reports that are not required for private firms. This, of course, is a cost that it will have to bear. For these reasons, timing plays a critical role in an initial public offering. The IPO needs to be carried out at the right moment. The company needs to be ready in terms of size, profitability, administrative capacity, growth potential, and investors have to be convinced that their money is in good hands. There are, of course, other ways to raise equity capital after an IPO. If at some point throughout the company's life cycle, fresh money is needed, the firm can raise capital through an SEO, or a private placement. SEO stands for Seasoned Equity Offering. The company's shares are already listed on the stock exchange, and it decides that it would like to sell additional shares in order to raise fresh capital. SEOs are similar to IPOs, but much simpler due to the fact that the documentation and regulatory filings have already been prepared and submitted. The valuation of these shares is much easier, given that the company is traded on the market. There are a number of investors who are already familiar with the company. The other type of equity offerings we can have are private placements. These are offerings that are exempt from a large part of the registration procedures necessary in an IPO. The securities are offered to institutional investors who are more sophisticated than retail investors and need less documentation in order to make an informed decision. In addition, this is the quickest way to raise capital. Okay, excellent. We've covered some of the main ways companies raise equity capital. In our next lesson, we'll discuss dividend payments. Stay tuned.